Well, good evening, everyone. Thank you for joining us tonight for this webinar on the current state of the homeowners insurance marketplace as a whole. So tonight, we're very pleased to welcome Joel Alcher as our featured speaker. Joel is a preparedness advocate with United Policyholders and an independent consultant. United Policyholders is a nonprofit 501c3 organization whose mission is to be a trustworthy and useful information resource and an effective voice for consumers of all types of insurance in all 50 states. Formed in 1991, they are active in three main areas: providing tools and resources to solve insurance problems after an accident, loss, illness, or other adverse event; by promoting disaster preparedness and insurance literacy through outreach and education; and by being an advocate for pro-consumer laws and public policy related to insurance. Prior to joining United Policyholders, Joel served for 35 years in the California Department of Insurance, and during that time, he held several positions, including Chief Deputy Commissioner, Deputy Commissioner of the Rate Regulation Branch, and Division Chief for the Market Conduct and Consumer Services. So with that introduction, I'm going to pass it over to Joel, and welcome.
Hello, thank you, Rich, and hello, everybody from the neighborhood. So appreciate the invitation, and I'm going to talk about insurance, everybody's least favorite topic, but one that we have to deal with, particularly if we own a home or an automobile. And I'm going to talk about how to kind of navigate the insurance market that we have today, which is quite challenging given our escalating wildfire risk, and hopefully give you some helpful information to kind of be able to shop for insurance if that becomes an issue, but also to better understand how the insurance marketplace works. So with that, I'm going to use a PowerPoint. Hopefully you're able to see that. And I'm going to start right now talking about how to keep your home protected with homeowners insurance. So next slide, please, Rich. There they are.
Okay.
Okay. So as Rich mentioned, I work for United Policyholders. It's a nonprofit that helps people with insurance issues. I actually interacted with them frequently when I worked for the Department of Insurance, typically at post-catastrophe locations where they were there to help people work through their total loss claims, which is a very challenging thing to do after a wildfire event, of course, is to work through the whole rebuild process and get the kind of the best result possible from your insurance company. United Policyholders is a nonprofit, all funded by donations and grants. We don't ask for anything for the people we directly assist. And, I was very fortunate that United Policyholders kind of let me, in my post-Department of Insurance retirement world, participate in their events, including this one tonight. So next slide, please. So I'm going to try and kind of give everybody a better idea of sometimes of how insurance works in terms of how premiums go up or down, or not down much recently, and how insurers select their business. And just as an example, introductory example here of how one of the recent increases that State Farm had approved by the Department of Insurance, and they have another big increase that is looming, but this one was approved now a couple of years ago, was for 20% rate increase. And a lot of people, look at their own premium at renewal, and they may say, it's not 20%. And that's because the rate increases insurers request are overall rate increases. So basically, on average, that's what the increase is. So just to give you an idea of how this one played out. So for Serrano, right, this year zip code 95762, the average rate increase was actually 22.2%. So again, that State Farm overall average plays out differently for every home and in every zip code. So even in Serrano, yours is a little higher than the average, but within that zip code, there are going to be people, again, that is an average for your zip code. So some people got lower increases, some got higher. And here's a listing here of some of the locations where I have recently made presentations. You can see some of them are lower than the 20% rate increase that State Farm got approved. Some are higher. I did one, you can see down the list there in red, Ojai. I went and did a presentation there. On average, their State Farm increase was almost 76%. So we're going to kind of see how that rolls out differently for homes. But, in general, it gives you an idea of higher risk communities versus lower risk communities as kind of sorted by State Farm's loss experience. They do have another rate increase pending. It went to a hearing. I'm not sure if that's been exactly approved or not, but likely there will be another double-digit increase for those who are still able to hold on to their State Farm coverage. Of course, we know State Farm has also done a lot of non-renewals. So next slide, please. So just to give a sense, this is the Serrano. This is kind of the general neighborhood, a satellite view. And those two circles there look like weird alien eyeballs, maybe looking at you. In the center of each one is a home. And the point of this map is to indicate, as insurers look at each home today, they have a model that will give them a score for each individual home based on a number of considerations. Some of the main ones are the slope at the specific location of that home, how close it is to a heavy fuel load, so that's forest or brush, the access level of that home, like how close it is to a firefighting department, or how accessible it is generally to get to the home, and more details. So even though these two homes, and the point of this slide is these homes may only be, a block apart, maybe even less, they can have a different score. And the reason is that one of the homes is a little further away from the fire department. It's a little further up the slope, or a little further closer, or a little closer to whatever the measurable fuel load in the area. And I know there were some questions about kind of inconsistencies of what insurers were requiring at underwriting, the same insurer requiring different things of different homeowners. Part of that is because of this scoring system. So as I mentioned, eligibility depends on this score, but also rates depend on this score. And also sometimes the requirements for mitigation may vary by risk score. So when you hear, a neighbor a block away didn't have to do some of the things you've had to do in terms of mitigating, some risk around your home, part of that may be because of a difference in the requirement between homes with one risk score versus homes with a higher risk score. So next slide, please. So, the earlier models that insurers started using were satellite imagery. That's what that last slide was intended to suggest. But now insurers use aerial imagery as well. And this is kind of to give you a sense of how that works. Looking down at this particular home, the insurer now is able to get a lot more detail about the home. And you can see in particular that at this address, there are tree limbs that are projecting over the roof line. And that's going to go right, that messaging comes straight to the insurer. And obviously that is a thing, that they do not want to see on homes that they are insuring. So while that might not have been called out over many decades, in today's market, insurers are more likely to identify these kind of issues and take an action, either potentially a non-renewal or a requirement that you remove the tree limbs or take some other kind of action before the policy will be renewed. It's one of the reasons it's particularly important to take note of what the insurer says is the reason for a non-renewal, because sometimes they get it wrong. Sometimes this is the aerial imagery of a house a few doors away. But so you really want to make sure you get right on top of it when you get a renewal notice. Make sure it's, it's accurate, and particularly a non-renewal notice where the insurer is obligated to tell you the specific reason for the non-renewal. And you want to make sure that's both an accurate reason, and if it is, that you do all you can to remedy the situation so that your policy will renew. So we've gone from satellite imagery to now using aerial imagery in underwriting and rates. Next slide, please. So one of the things everyone possibly can do, and which will lead to discounts, because these are mandatory discounts an insurer has to offer to residential coverages, are the Safer from Wildfire checklist of coverages. And they range from, you can see, a Class A rated roof, which luckily most people have, enclosed eaves, fire-resistant vents, down to property level mitigation actions like keeping a 5-foot zone 0 around your home where there are no combustible materials within 5 feet of the exterior of your dwelling, and down to also getting a discount for a FireWise USA community. So every insurer doesn't necessarily require every one of these actions, but in California, every admitted insurer has to give you a discount for each of these actions. And the FAIR Plan also gives discounts for these actions, but for the FAIR Plan, to get the building discount, you have to do all of the building related mitigations. And to get the property level discount, you have to do all of the property level mitigations. For every other insurer, basically, that's admitted, you get a discount for each action you take. They're fairly small discounts, but at least it is something given how much premiums have been increasing over the last few years. So that's, again, Safer from Wildfire. There's another set of discounts from an entity called IBHS, and theirs is called Wildfire Prepared Home. Many insurers will give you discounts for that set of actions too, and there is a significant amount of overlap between a Wildfire Prepared Home set of discounts and the Safer from Wildfire discounts. But again, it's mandatory that every insurer give you the Safer from Wildfire discounts if you've taken these actions. So next slide, please. So if you are non-renewed, and obviously that is a major concern in today's marketplace, an insurer has to give you 75 days notice. And that's in California law. So it's important not to put that aside. I know it's a drag to receive that, and very bad news given how difficult it is to find another insurer. But you can't just put it aside and ignore it. You need to get right on it and start shopping for another insurer. It's going to be very challenging in today's market to find another insurer if you have any level of wildfire risk at your home. But you really want to make sure you do a thorough shopping job. You want to not just stop at the one agent who may have represented you for your current policy. If they can't find coverage, with among the insurers they represent, you're going to need to probably shop with multiple agents, and each agent typically only represents 4 or 5, maybe 6 insurers. And there are many insurers that write homeowners insurance in California, dozens actually. So it means contacting multiple agents, finding out the reason, that if you do get rejected, what was the reason for the rejection? Is there anything you can do about it? There's a lot of things you can't do about it based on the landscape where your home is located, but some things are in your control. So you want to make sure you do everything you can. And you really want to make sure you thoroughly shop the insurance marketplace before you settle for a California Fair Plan policy. So next slide, please. So there are, a number of reasons that are common reasons for non-renewal. Wildfire risk is one that you may not be able to do anything about, but sometimes it's the type of roof or the age of the roof. A lot of insurers used to write wood shingle roofs. I don't think any insurer will write new business for a wood shingle roof today, other than the Fair Plan, because they're kind of obliged to. But insurers use age of the home. They're looking more at some of the issues they have with other concerns, such as aging galvanized pipes that sometimes burst, or knob and tube wiring. That's typically a Victorian home issue. Pools are a liability concern, as are trampolines. And some insurers are capping their values of home they're willing to write at lower amounts. But wildfire risk is a main driver, one you may not be able to do a thing about other than search the marketplace to see if you can find an insurer that's willing to write at a higher level of wildfire risk. And also, the only other thing you can do is try to implement every one of those mitigations that you possibly can. So to make your home as appealing to an insurer as possible. So next slide, please. So know your rights. You, as I mentioned, you're entitled to be treated fairly by every insurer. If you meet their eligibility guidelines, they have to write you. If they non-renew you, it has to be for a reason that they state. And if you can correct it, they would need to renew you. You want to communicate with your agent or insurer to see if there's anything that you can do to lower your risk score or lower your premium. And know that the Department of Insurance is available to you to ask questions. See their 800 number, there's a little concealed, but it's an 800-927-4357, or write to them. They have a consumer services branch that handles consumer complaints is their entire job. So use the Department of Insurance, use United policyholders, but really make sure you get right on it if you get a non-renewal. And even if you end up in the Fair Plan at some point, don't just assume you have to stay there. Keep searching for coverage with markets that you might not have checked previously, and maybe the mitigations you have done since the non-renewal may make you eligible with another insurer. So next slide, please. So know that at the Department of Insurance webpage, there is a page where you can find all kinds of information to help you shop for insurance. This is under the homeowners tab. There is a top 10 tips that I've highlighted on the Department of Insurance website. I actually created that page, but among those top 10 tips are the 800 number of every admitted insurer that writes homeowners insurance in California. So you can call that 800 number and see if they have a local agent or if they write directly. There's an insurance finder tool that can help you search the market. So, don't give up without really doing a thorough search of the homeowners market if you do get a non-renewal or if you do end up in the FAIR Plan. So keep searching for an admitted carrier if you can. Next slide, please. Just an example here is that link to the 800 numbers. There are a lot of companies you may have never heard of: American Modern Insurance and Tokyo Marine Insurance. Most everybody's heard of the same 5 insurers that advertise on television again and again. But please be aware there are a lot of smaller insurers that do write coverage. I'll admit that this can be very much a wild goose chase if you have even a moderately high wildfire risk. But really, you want to do all you can to avoid being in the FAIR Plan. So if you're willing to go through it, call 800 numbers, find a local agent, or try and get a quote just to make sure there is no other option available to you other than the FAIR Plan. Next slide, please. So here, there are very few things you can do to save money on insurance right now. One thing I mentioned previously was to do all those mitigations. And again, that the mandate that all admitted insurers have to give you discounts for those mitigations. So, and then ask your agent or your insurer directly what other discounts they do make available. Pretty much every insurer will give you a discount on your home and your auto if you bundle, we'll say, both of those with the same insurer. Another thing you might strongly consider is raising your deductible. If you've been sitting with a $500 or $1,000 deductible that seemed like a lot of money to you 10 years ago, but now you can afford a little higher loss than that, and also you want to lower your premium. Think what level of deductible would you be willing to absorb if you had a loss? Maybe you're willing to pay $5,000 or $10,000, given that in almost every case, a major loss may never occur. And you get an immediate reward if you raise your deductible by having a lower premium. And you're really unlikely to file a small claim. Small claims are something insurers don't like to see because often small claims kind of give an insurer an insight about some other risk at your home. So you really want to avoid small claims. Keep your insurance for major losses, and that means raise and keep a higher deductible level. Next slide, please. So one thing to know when you're shopping, there are 4 categories of insurance company out there. Admitted and licensed, that's the one I keep emphasizing is really what you want to do. Those are the ones whose rates are regulated by the Department of Insurance. They are backed by the California Insurance Guarantee Association in the remote chance that any one of them becomes insolvent. That's very rare, but it has happened in California. And the most recent one was an admitted insurer. And so all of its losses were paid despite its insolvency. There's no guarantee of that with a non-admitted insurer, sometimes called a surplus insurer or an excess lines insurer. They have no rate controls. They still do have to follow, a lot of the California rules, but rates aren't controlled. They're not backed by a guarantee fund, and your only assurance of their financial strength is to check their financial rating. So if you already have a non-admitted insurer, you really want to make sure they're at least a B+ on a best rating, or an A is much better. You don't want to get anything less than that, because you want the security that your insurer will be there to pay a claim if you do have a major loss. There's also the FAIR Plan. Many of you may already be familiar with that option. It's a tough one. We are fortunate to have a FAIR Plan in California. It is financially secure in that if it does run out of surplus funds, it can do an assessment on the admitted insurance industry to make sure all of its losses are paid. So that is a major benefit of at least being with the FAIR Plan, is financial security. If you do get a FAIR Plan policy, which is essentially just a fire policy, you're going to still want to add what's called a difference in conditions policy or a wraparound policy. That's the same thing, to provide water damage coverage and liability coverage. Water damage coverage is like the second most common cause of loss in homes. So you really don't want to go without that. Pipes do burst and do major damage at times. And liability coverage, also very important. It's not that common of a loss, but it can be a significant loss. If somebody, for example, injures themselves on your property, you'll want to have liability coverage from an insurance company. Forced placed or lender placed coverage is a coverage that your lender will purchase to cover its own assets, the amount of loan that it has provided for your property. It covers only the lender, really. Does you no good, but you will have to pay for that coverage if you don't put another coverage in place if you get non-renewed by your insurer. So you need to maintain your own coverage, or your lender will place a coverage that benefits only themselves if you don't honor that loan part of the loan commitment. Next slide, please. So one thing, of course, I want to recommend is that you go to uphelp.org for an array of information that's available to you, things you really want to know about your insurance coverage. One of our pages is about the FAIR Plan. You can see this is /CFP, California FAIR Plan, to get a lot more detail and relatable information about what the FAIR Plan provides in terms of coverage. As I just mentioned, you can kind of see by this little diagram here, the FAIR Plan is mostly about fire. The difference in conditions adds that water damage, theft, and liability coverage that almost everybody wants to have. And combined, they equal comprehensive coverage, much similar to what a homeowner's policy provides in a single policy. So again, if you're in the FAIR Plan, you want a DIC policy as well, if you can afford it. Next slide, please. And one thing you really want to avoid is underinsurance. A lot of policies really understate the construction cost to rebuild your home. It's a good idea to try and get some understanding of what a rebuild cost is in the vicinity of your home, and kind of at least, how many hundred per square feet does it cost? Although the likelihood of loss is, it's very unlikely you will ever have a total loss, but that is the reality for everyone, that including those that have had a total loss. And the purpose of having your insurance is to be able to rebuild. You don't want to end up with a coverage that falls way short of being able to do that. So try to at least get in the ballpark of reasonable for a limit that would actually be able to rebuild your home, or approximate that should you have a total loss. Next slide, please. And one thing that is a painful thing to do for people that have a major insurance loss is to go through the claims process to recover their limits for contents. Insurer can require that you list everything you lost, when you bought it, how much you paid for it, what condition it was in today, and only give you the actual cash value of that item till you actually replace it. There are a lot of things you might even forget you had. So just to make life easier on yourself and perhaps facilitate your claim, just take your phone, walk through your home, taking a video of everything in your home, including in your closets and cabinets and drawers, so that you'll have some proof for your insurer that yes, you did own all this stuff that you're saying you owned. Can make the claims process a lot easier. It'll help your recollection, and you may not even have to go through the inventory process, if you provide this kind of credible evidence of your belongings. Next slide, please. So, one more, one back. So, and then one forward. There we go. So one thing to be aware of, some changes are coming in how insurance rates are regulated. The Department of Insurance has amended its rate regulations. That they will now be allowing catastrophe model losses. That's something insurers weren't allowed to use in California before. So they will be using these projections of future catastrophe losses to build their rates, rather than based on their historic catastrophe loss history. It's kind of technical, but the baseline is there, that you can expect that rates will be increasing significantly due to these model projections. Also, insurers will be able to pass along their reinsurance costs in their cost of premium to their policyholders. That's the insurance that insurers buy for themselves in order to cap their catastrophe losses. So they'll be passing that cost along to homeowners as well. So no good news here. In terms of premiums are just going to keep going up for a while. The hope here is that allowing these changes will increase the availability of coverage by more insurers coming back into the marketplace, and existing insurers being willing to, again, expand where they're willing to write, because they'll be able to pass along these costs of reinsurance and more accurately, in their view, predict what their future losses will be in the rate making. So again, maybe more availability, but definitely higher premiums. Next slide, please. So I'd ask all of you who are participating or listening that you take our home survey at uphelp.org. Again, UP Help is really there for you, the policyholder, trying to give you all the information that's helpful that we possibly can, including what I hope was a helpful quick overview of how insurance works in California this evening. So please take our survey. And next slide, please. Again, uphelp.org. And now I'm willing to take any questions you might have. If we
All right, well, thank you very much, Joel. Do appreciate that important information. So for anybody who's interested in asking a question, if you have a question, please press the raise hand button at the bottom of your screen. On my screen, I should see that action, and then I'm going to send a message to you to unmute. Okay, Bill, I see that you raised your hand there. If you can just go ahead and press the blue unmute button and then go ahead and speak your question.
Okay, can you hear me all right?
Yes, we can.
Okay, perfect. Joel, in Serrano, we're starting to see, the first, it was Farmers Insurance that started to require IBHS certification for renewals. And now recently I'm hearing from homeowners that Allstate is not using IBHS, but they're requiring some of the basic mitigation requirements in the certification, such as either boxing in eaves or the option of boxing eaves or putting in a 5-foot zone, vents, ember resistant, and then replacing wooden gates and fences 5 feet from the house. Where are insurance companies heading? I mean, are they going to? Do you see them adopting either the Safer from Wildfires or the IBHS more consistently, or are they just going to operate on their own independently? And we were not sure what insurance company is going to require for us.
Right. So thanks for that question. So insurers have to offer a discount for the Safer from Wildfire mitigation actions. So that's already going to be built into their rating plan. It doesn't necessarily mean it would be built into their underwriting or that meaning their eligibility guidelines. But I think that is what is starting to occur. And just so everyone understands, an insurer has the ability to choose whatever level of risk it is willing to write. And they can change that at any time moving forward, as long as it's kind of fits in with their rate approval. So what we're seeing is that, and as you mentioned, while insurers some of them are just, they're giving the Safer from Wildfire discounts, but not necessarily requiring that somebody meet all those standards. Some of those standards were pretty much a mandate already. For example, almost no insurer will write a wood shake roof anymore. So that's one of the Safer from Wildfire standards, but that's also an independent standard that insurers already had in place. So now we're seeing insurers, they're free to choose, again, their level of risk. So I think what you'll see is for certain homes above a given wildfire score, there will be the requirement that many of these mitigation actions be taken. That may not be required of a home with a low wildfire score. And so you might see what seem like inconsistencies in how an insurer operates, but they're not inconsistent when you look at the big picture in terms of the higher the risk, or the higher, the more challenging the location, the more requirements the insurer might have in place. And as I showed in that one of my screenshots of your community, a home can have a different risk score, even if it's just a few doors down the road. So one home, a few doors away might have lower mandates that it has to meet than the one a few doors up the road that has a little higher risk score. So it's going to seem inconsistent, but insurers are obligated to be consistent. You just may, and sometimes they may not be, which of course they're, the Department of Insurance should know, but sometimes it's just something you don't see. You don't realize, oh, okay, that other home had to do this because they had a different risk score. And yeah, I do expect that most homes in any degree of wildfire risk are going to see more and more mandates come through, because the Safer from Wildfires mandates are something that insurers have to do. That might be more likely that more insurers will do that, but insurers fund IBHS, and so they certainly trust IBHS research. And I think, and I will say those two, Safer from Wildfire and Wildfire Prepared Home mitigations, are almost identical. One of the more challenging ones is the Safer from Wildfire Enclosing the Eaves mitigation action, because most people don't ever do that. And it's hard to find someone that will do that for you for a reasonable price. But yeah, we're just going to see more and more requirements. Long-winded answer to your question. More and more mandates to do those mitigation actions to be eligible for renewal.
Okay, thank you.
Thanks, Bill. I see, John, you have a question. If you'd press the unmute button and go ahead and speak your question.
Thank you, Joel. Great presentation. My questions are pretty much along the same lines. Is that I'm in Serrano, and we got a notice from our insurance company that they are going to proceed with our renewal, but pretty substantial increase. And they have a whole list of hit items, right? And one of them is that this is a community that is a fire safety protected community. But then there's a whole list of other things like, encapsulating your eaves and things like that. I have very small reductions in costs, but could be very expensive to do. And my question is like, is there any place we can go and look at, the increase in costs? Is this like what we should anticipate? But from the sounds of your presentation, it's kind of difficult for that to happen because very small changes in location and things could cause a large change in the increase in the rate.
Yeah, unfortunately, there's no real way for a consumer to anticipate what their rate increase will be, or even if you were to log into the Department of Insurance website and see, that their particular insurer has an increase pending, because and that was the point kind of the State Farm slide that I had. What you're seeing is the overall rate increase, but it plays out based on many considerations of details about the home, the age of home, the zip code, the type of roof, the mitigations you've done, the type of plumbing. So you really can't foresee what an insurer is going to charge. The only thing you can do is that's in your control. And I will say, while the Department of Insurance mandated that all insurers adopt those Safer from Wildfire discounts, because the insurers really don't have the data to predict which ones will be the most effective or not, what they kind of adopted were placeholder kind of minimal discounts. So yes, you could spend $10,000 to have your eaves enclosed, only to get a $100 discount on your policy. But, the more important consideration now is keeping your policy with an admitted carrier. So, to my understanding, the majority of carriers aren't requiring enclosing of the eaves as one of the mandates. But of course, if you're at a higher risk score, there may not be many insurers that are competing to write a higher risk score. So it's not like you can just go to another insurer. So, you still might want to shop around to see if you can avoid enclosing the eaves and save that money, but still find coverage. But again, it's a super challenging market. And, the mandates just keep, that insurers are imposing, just keep getting more and more requirements and fewer options for consumers. So you're kind of, you want to make sure you do all you can to keep your coverage with an admitted insurer.
That makes total sense. Thank you. That's a great answer. I guess a more broad strokes question to that is like, so my insurance company is basically saying, okay, we're going to renew you, but your increase is going to be 30%. Is that like a logical number to expect for an increased insurance? Again, that's a hard question because it depends on your safety level. Fairly safe level here in Serrano, and pretty much all the requirements. If you look, they have a checklist like $11 to $120 for multiple points, which you can improve your house. That's going to be deducted, and most of it's already approved for me. So is that sort of, what range would you sort of
Yeah,
comfortable?
it varies significantly by insurer. And I will mention, so the rate filing now a couple of years old that State Farm is implementing still was a overall, I think, 30% increase. And in that increase, there were actually some people that got a rate reduction, a very tiny number compared to the ones that got major and double-digit increases. But State Farm's subsequent filing, which I think was maybe the subsequent one was for 30%, and now they're looking to compromise it. That was for like, that would have been played out, let's say it was 20%, it would have played out the same in every zip code. So it still would have been an average, but it would have been closer, people would have paid closer to each other in terms of increase than that one State Farm took. So it really varies. Like I say, sometimes with a rate increase, some people in a certain type of home might even get a rate decrease. Rate increases are all based on essentially historical losses, like what types of homes cause losses for the insurer. Were they homes on slopes? Were they older homes? Were they homes, with wood shingle roofs? Well, if that's all true, then those homes get the bigger increases, and the other homes that are newer or flat ground have lower increases. And it varies insurer by insurer. So there's really no way you can predict where it's headed, other than, we've heard, of course, how big the losses were in Los Angeles.
Right.
Those fires, those losses won't be restricted in terms of impacting homeowners' rates in LA. They will also impact statewide based on homes that are similarly situated to those LA homes. And again, it was mostly homes on slopes or near brush or near forest or were older. So, homes that are those zip codes and the vicinity of those homes will probably take the major hits, but similarly situated homes throughout the state will also feel the impacts of those losses. And, it's kind of a situation where, this won't stop until we have a long lull in wildfire losses, right? We need to somehow turn around our increasing fire risk. And part of that is things that communities are doing. And I know in your area, right, Firewise communities, we're hoping that as those concentrations of Firewise communities proliferate, we get herd immunity. And as you know, and wildfire has a lot more trouble spreading if that wave of sparks is defeated by Class A roofs and ember resistant vents, and the fire doesn't range from your fence to your house because you have a zone 0. So it's up to all of us to turn that around. And until we do, premiums will keep going up, and availability going down. And sorry to deliver that obvious news, but
It is obvious news, and
Yeah.
thank you. That was a great explanation. Thank you.
sure.
Thank you for the question, John. And I see that Roxanne has a question. Roxanne, if you press the unmute button, go ahead.
Yes, my question is, our insurance company, before they let us go, wanted us to cut down some of the trees and, as you said, remove some combustible plantings within 5 feet of the house. And I assume Serrano HOA is on the phone. And I was wondering, how do we deal with that? Is that something we can do as homeowners in this community in Serrano?
Are you asking that of Serrano?
Well, I'm actually asking the HOA if they're on the phone too.
Okay.
If we put in some of these measures, is that acceptable to the homeowners association? Because I know we have some strict guidelines on what we can and we can't do for plantings and tree removal.
Yeah, Roxanne, I can try to take a stab at that. I don't believe there's anybody from the HOA on the webinar.
Oh, okay. I'm sorry. Okay.
So the thing what I say is obviously what you're going to have to follow is the standards that are provided by the design review committee in the guidelines that are provided when you purchase the home. So relative to planning materials, any modification that you make have to go through an approval there. That would also apply to any sort of proactive changes that you made relative to home hardening. So yes, you are certainly able to do that, and we encourage you to do that, but it still has to go through the same approval process as if you were going to do something that was unrelated to home hardening.
Okay. So I understand. I just hope the HOA is more giving and open-minded to helping us achieve this goal of being safer from possible fires, and we're not stuck with some of the old guidelines that are as they're written. So thank you.
Yeah, and I believe they are. I know for the Fire Safe Council here, we have been advocating and to move in that direction, to give more latitude to homeowners, and also to give more flexibility to reduce the cost of those improvements that are going to harden the home and protect against wildfire. So it's a process that's in progress, but moving in the right direction.
Okay. Thank
So
you for
thank
that
you.
information.
You're welcome. And then Steve, I see you have a question. If you press the mute button and go ahead.
Can you hear me now?
Yes, I can.
Yes.
Okay, yeah. So for Joel, I've got a question, a little bit different type of question in that, have you heard of the company called First Street Analytics? And apparently I ran across this company name looking at Zillow and Redfin. I'm a Serrano resident as well, and I was surprised to see that these apps apparently contract with this analytical company that does these, climate risk assessments throughout the country, I believe. I suppose using satellite imagery. But I'm just wondering about the credible source that they may or may not be, and whether or not insurance companies are using this, because I was astounded to see that it actually had the Serrano area listed or categorized as extreme fire risk.
Yeah, I wouldn't rely on that in terms of what insurers are using. I mean, it probably has some internal logic that, may be credible at some level or significantly, but insurers use kind of an array of different vendors. Some of them have been around forever. Verisk, or Insurance Services Office, has a tool they've been using for years and had incorporate these things that I mentioned: slope and fuel load and access. CoreLogic is another one. But then newer vendors such as Zesty AI is one that provides aerial imagery. But there are an array of different vendors that provide information to insurers, taking into account not only just those landscape features, but also things like what is the footprint of historic wildfire, right? How does fire move through a given environment, for example? Or what is the combination of fuel and wind direction in a given area? So they're constantly innovating wildfire risk models, a lot of competition, to get major insurers to use their product and then use that in their underwriting, for eligibility, and also in their risk scoring of who's going to pay more or who's going to pay less. So, Zillow, they have some vendor that may be credible, but, there are an array of credible vendors doing a lot of kind of data-driven determinations of where higher risk is. And
Okay.
insurers use different ones.
Okay, thank you.
Mhm.
Thank you, John. Or Steve, I'm sorry, excuse me. So if there's any other questions, just please go ahead and raise your hand and I can identify you. Bill, looks like you have another question. If you can go ahead and press the unmute button. Bill, are you there?
Yeah, can you hear me?
Yes, we can now.
Okay. I want to respond to the HOA question. It was a very good question, and I served on the board for 2 terms and until a couple of years ago. One of the things we did when I was just finishing with the board is to establish a policy, the board of directors did, that they will support and work with any homeowner who proactively wants to implement some of these mitigation measures to protect their homes, and homeowners that are required to do it to keep their insurance. So the HOA is working with people who are doing zone 0, in other words, clearing vegetation 5 feet away from their houses. They're working with actually 2 of us here, Rich and I, and some others on the wood, replacing wood fencing with metal. So yeah, the HOA is, and at the same time, they're learning like we're learning. And so their guidelines are starting to evolve, and they're being, I think, extraordinarily flexible in putting homeowners first to deal with this situation we're dealing with.
Thanks, Bill. And John, I see that you have a question.
I'm sorry, I don't mean to dominate, but that brought up the issue of a great response to that. And the HOA, I mean, we're required to have wood fences right up to our frontage of our houses and stuff, and so a lot of the fire mitigation stuff requires us not to have wood coming up there. And so Bill, you're saying that the HOA is aware of this and that we can implement this and send them plans associated with not having wood fences and putting metal fences up in the front of the house like that?
Yeah, and I see Bill's going to have a comment on this as well too, but I can answer that question as well. Yes, the HOA has taken proactive action in that regard. In fact, as of the February 28th board meeting, they made modifications to the regulations that will allow you to install a non-combustible wing fences. I know this personally because I'm doing it myself. It has to follow design standards, however, but they are supportive of those type of actions. And I'll let Bill go ahead and make additional comment on that as well. Bill, go
Okay.
ahead.
Yep, can you hear me?
Yes, we can.
Okay. Yeah, so I echo what Rich said. We're working with them on the fences. But also with the 5-foot zone, even though that's, you just need to be aware that in Serrano, if you're making any changes to your front yard landscaping, no matter what it is, whether it's a 5-foot zone or whatever, you have to have an approved plan, a plan approved by the DRC. And the same thing with the attached wood fences and gates. So you don't want to go make those changes without being pretty sure that you're going to have approval from the DRC or the HOA. What you do to your side yard and backyard is they're not involved in that. So that's, they're going to approve what you do in your front yard, but you can continue that on your back and side yard or do it slightly differently. That doesn't require an HOA plan and approval.
Thank you. I totally understand that. Second, kind of a follow-up question to that is, I know you guys have the fire prevention committee here in Serrano, which is, I think, a great idea. So like, can we have them come out and look and say, do these trees need to be cut back further from the house and things of that sort, so that we can directly address those questions, but also have a secondary party saying that this needs to be done, so we can go to our neighbors and say, well, I need to cut your tree back, or our own trees, and if they're in the front yard, to push for those to be done. Can anybody comment on that?
That is an excellent question, John. And Bill, I did not put him up to that. I think you are still unmuted if you want to go ahead and address that question.
Okay. Here's a great asset we have in El Dorado Hills. The way to get your question answered is to contact the fire department and request an assessment, not an inspection, but assessment. The fire department, they've got 2 really great inspectors. They'll come out and spend about 45 minutes with you, walk around your house, let you know, kind of educate you on where you're vulnerable, things you can do to make your home more resilient. So they are great, and they'll be really responsive. So I would go to the fire department. Sometime later this year, there's 4 of us that are getting trained by CAL FIRE to also provide the same kind of assessments for the homeowners. So when we get into, after probably the late summer, the Fire Safe Council, the Serrano Fire Safe Council, will be offering the same no-cost services. So right now, the fire department will come in and give you that assessment at no cost. All you have to do is get on their website and request an inspection, but tell them you're asking for an assessment when you make that request on their website.
Great, thank you. Does anybody else have any questions? I don't see any, but I do have one for you, Joel, and this is really kind of a crystal ball question, is that with the insurers in the state of California now being able to look at forward-looking models to have reinsurance cost as part of the premiums that are paid, they're seeing rate increases being approved, and then also going forward, we know that Governor Newsom had signed earlier this year legislation that was actually going to put zone 0 requirements in place for new builds next year, and then for existing construction 3 years after that. what do you think the future looks like for insurance in California? Is there cause for optimism here? What do you think is going to take place over the next 3 to 5 years?
Well, I feel you always should just go with optimism, even if it's not necessarily supported by past events. You know, there are a lot of forces that kind of take place in this whole process. And one of them that has taken place over many years is a concentration of business in a very small number of insurers. So, you know, you said at the outset that I've been in this business a long time. There used to be many more insurers writing coverage. And over the years, there's been kind of, you know, more concentration of business with a small number. You know, there's still a lot of insurers that write homeowners insurance, but really the market's very concentrated in the top 5 or 10 insurers. And now those insurers, of course, as they kind of want to write less business now that they're having losses, you know, they've kind of killed off most of the market that might have written that business years ago. And so I'm hoping that over time, you know, more insurers will take little bite-sized pieces of risk and kind of grow a little bit this way so that we're not so dependent on the top 5 insurers, you know, to write more business or rule the market. I do think the price increases will help, but, you know, insurers are generally looking for, they want the chance of loss to go down even more than they may want the chance to increase premiums to go up. So I'm hoping this was our final year in increasing losses, and that we're starting out in these months ahead to be on a downhill slope for homeowners and business losses. And that's the really only way you're going to bring a vital market back and reduce, you know, their basis for charging higher rates. So I'm going to we'll be optimist, and, you know, we've had the last of our worst and we're moving towards our best.
All right. Well, with that note, thank you, Joel. Appreciate your presentation and time tonight. And then thank you for everybody in the audience for attending and your questions. A PDF copy of the presentation will be provided by email in the next few days. Be on the lookout for our next webinar in the coming months. And as always, check out our website, serranofiresafecouncil.org, for additional information. Thank you and good night.
Thanks.